svi nama došli na novembarsku prezentaciju.
Ladies and gentlemen, welcome to the presentation of the November inflation report. So, ladies and gentlemen, my dear colleagues, esteemed members of the press, before we elaborate in more detail on the current macroeconomic developments and our new projections, I would like to highlight that despite heightened uncertainty and external challenges, developments in many areas are either in line with or better than what we expected at the time of the previous report. I here have in mind the following. Inflation declined to 8.5% in October, moving somewhat below our August expectations over the past months. Owing to a robust bank regulatory and macroprudential framework and moderate monetary tightening, financial stability has been preserved and the NPL share in total loans is close to its historical low. In the third quarter, GDP growth picked up to 3.5% year-on-year, exceeding our earlier expectations. In light of favorable developments, our GDP growth projection for the entire year is now around 2.5%. We have seen a major improvement of our external position. In the 9 months of this year, the current account deficit measured only 1.6% of GDP, with FDI inflows exceeding it multiple times. As a result, FX reserves rose to a new record high of 24.4 billion euros at end October. The fiscal deficit will be lower than initially planned and will measure around 2.8% of GDP in 2023, thanks to better than planned revenues and reduced transfers to the energy sector, which will accelerate the downward trajectory of public debt. Also, at the very start, I would like to highlight several more things that I consider crucial from the viewpoint of the National Bank of Serbia's competences and tasks. First of all, the measure of capping interest rates on variable rate housing loans is well calibrated in all respects. The adoption of this measure and its effect on the banking sector financial result are estimated not to jeopardize in any way the operation of the banking sector, while contributing to the preservation of financial stability by preventing a rise in non-performing loans. At the same time, household disposable income is also increased, but it should be borne in mind that it cannot jeopardize the downward trajectory of inflation, as it makes up merely around 0.3% of total household consumption in a single year. It can only contribute to the recovery of consumption, which is indispensable for achieving the desired economic growth. Second, already in the first quarter, or no later than early second quarter next year, the National Bank of Serbia's real key policy rate will return to the positive territory, with year-on-year inflation and inflation expectations going down. In other words, even by keeping the key policy rate at the current level of 6.5%, the National Bank of Serbia will act increasingly restrictively, lending a strong impetus to the disinflation process. That our monetary and overall economic policies are adequate is also attested by the IMF's positive second review under the arrangement, which, given the created buffers, will become a precautionary arrangement most probably already in December. This contributes to a favorable investment environment, which is also confirmed by the high investment inflows into the real sector, elevated interest of foreign investors in government dinar securities at recent auctions, and the country's credit rating maintained one step away from investment grade. Later in the conference, we will present in more detail macroeconomic developments in the international and domestic environment and our new projections. Trends in the international environment continue to largely determine domestic macroeconomic development and are the key risk to our macroeconomic projections. The majority of relevant international financial institutions agree that the global economy has proven to be more resilient than initially expected, despite the consequences of the pandemic and the energy crisis, which caused disruptions in the world food and energy market and pushed up global inflation, as well as despite monetary tightening. In the first half of the year, the euro area, our key trade partner, managed to avoid technical recession. Still, according to the Eurostat estimate, the third quarter saw a moderate decline in activity. The leading monthly indicators suggest that production contracted early this year. Subdued euro area external demand is generating disinflationary pressures on our economy, but may also slow down export growth. Nonetheless, owing to rising export supply, in the year to September, our goods exports recorded relatively high growth rates, with exports to Germany accounting for around 40%. More information about this is contained in one of the text boxes in the current inflation report. Next year, with the expected recovery of Germany and the acceleration of economic growth in the rest of the euro area, our production and manufacturing exports are likely to expand. Global inflation has slowed, owing mainly to falling world prices of energy and food and the effects of past monetary tightening, which is likely to drag down inflation at home in the coming period. Given the established downward trajectory of inflation and its expected movement going forward, it is estimated that central banks of advanced economies are probably nearing the end of the monetary policy tightening cycle. However, due to persistent risks, tight monetary conditions will be maintained for some time yet, while on the other hand, some inflation-targeting regional peers have already started or announced the start of monetary policy easing. One of the text boxes in the current issue of the report is dedicated to the outlook for global and domestic inflation and the dilemmas facing monetary policy makers in the current circumstances. When it comes to risks to the projection, caution in the conduct of the National Bank of Serbia's monetary policy is mandated by heightened geopolitical tensions, which have intensified with the latest developments in the Middle East. This fuels uncertainty in commodity and financial markets, triggering volatility of the global oil price over the past weeks, and a moderate rise in the risk premium of emerging economies. Still, according to the estimates of relevant international institutions, unless the conflict spreads, we should not expect any major effects on primary commodity prices on this account, and on global inflation either. The macroeconomic effects of the materialization of the risks of escalating geopolitical tensions and their potentially faster than expected resolution are examined in our text box on alternative projection scenarios. Year-on-year inflation in Serbia has been on a downward trajectory since April. In the past 3 months, it measured even less than envisaged by our August medium-term projection. The slowing of inflation to 8.5% in October and its return to a single-digit level is the result of lower growth in food prices and prices within core inflation, that is, consumer price index excluding food, energy, alcohol and cigarettes, which softened to 7.3% year-on-year in October. Such movements in core, and by extension headline inflation, reflect the dissipation of global cost-push pressures, monetary policy tightening, and the decline in short-term inflation expectations of the financial and corporate sectors. Under our new projection, after falling to around 8% late in the year, year-on-year inflation will most probably retreat within the target band towards mid-next year and continue to slow thereafter, approaching the target midpoint in late 2024. Such movements will be aided primarily by the effects of past monetary policy tightening, subsiding global cost-push pressures, slowing of imported inflation, and subdued demand amid weaker global growth. Though in our new projection we expect global oil prices to be higher in late 2023 and in 2024 amid mounting geopolitical tensions, the inflation projected for 2024 is almost unchanged relative to our August expectations, as inflation has receded in the past 3 months at a faster than expected pace, and inflation expectations have subsided. Since inflation is expected to move within the target band over the monetary policy horizon and the full effects of past monetary tightening on inflation are yet to play out, we have decided to keep the key policy rate unchanged at 6.5% in the period since the previous report. In September, we raised dinar and FX required reserves in order to mop up surplus dinar liquidity in the market. The transmission of the effects of past monetary tightening to interest rates in the money, lending and savings market and to the volume of lending to the private sector signals the effectiveness of the transmission mechanism through the interest rate and lending channel. The decline in 1 year ahead inflation expectations of the financial and corporate sectors and the movement of financial sectors 2 and 3 year ahead expectations within the MBS's target band indicate that we have helped contain inflationary pressures through the expectations channel as well. When it comes to corporate lending, it should be noted that companies' demand for liquidity loans has diminished due to increased profitability, while investment loans continue to post solid growth of around 4% year-on-year. It is also important to emphasize that we have been tightening our monetary policy continuously but gradually, taking care to minimize the effects on financial stability and economic growth. At the same time, we chose not to wait for the risk of rising interest rates in the euro area to materialize and affect the capacity for repayment of housing loans in the domestic market. Instead, in September, we decided to cap the interest rate at 4.08 for first-time beneficiaries of variable rate housing loans whose contracted amount does not exceed 200,000 euros. At around 3% in September, the share of non-performing loans in total loans clearly confirms that financial stability has been preserved as a result of a robust regulatory and macroprudential framework and measured tightening of monetary conditions. Economic growth picked up speed in the third quarter. According to the source flash estimate, year-on-year GDP growth measured 3.5%, which, in our view, was underpinned primarily by construction due to accelerated implementation of infrastructure projects. Though external demand slackened, manufacturing posted better than expected outturns, propped up by past investment and rising domestic demand. Further, data on the yields of key crops indicate that this year's agricultural season was better than average, exceeding our expectations from August. A positive contribution also came from most service sectors. On the expenditure side, third quarter growth was led by rising investment, mostly of the private sector. Net exports also gave a positive contribution, though lower than in the first half of the year, as real growth in the exports of goods and services continued up and imports declined further. Owing to favorable movements in the third quarter, we now estimate that the GDP growth rate in 2023 will measure around 2.5%, whereas in August we expected it to settle closer to the lower bound of the projected 2 to 3% range. A key contribution to this year's GDP growth will come from net exports, even as the imports of goods and services are expected to accelerate and exports decelerate in the third quarter. On the other hand, we expect overall domestic demand to stagnate. Fixed investment will go up thanks to increased corporate profitability, high FDI inflows, and government investment in transport infrastructure. A positive impulse is also anticipated from private consumption, which is expected to rebound in the fourth quarter on the back of an increase in employment and wages in the private and a part of the public sector and in pensions. We expect that the depletion of inventories will work in the opposite direction. As global inflationary pressures wane, the euro area, our key trade partner, recovers, and the implementation of investment projects in the area of transport, energy and utility infrastructure gains speed as planned, we expect Serbia's GDP growth to step up to 3 to 4% as of 2024, and then return to the pre-pandemic growth trajectory of around 4% per year. Growth will be led by domestic demand, notably private consumption and private investment, as a result of receding inflationary pressures, preserved labor market and investment confidence. The achievement of the projected GDP growth rate in 2024 will also be facilitated by a stronger carryover effect than in 2023, resulting from accelerated economic growth in the second half of this year and estimated at around 1.5 percentage points. Our external position situation continued to improve in the third quarter. Hence, in the 9 months of the year, the current account deficit was just shy of 800 million euros, which is as much as 2.5 billion euros lower than in the corresponding period of 2022, and at the same time, the lowest deficit to date. The current account deficit declined mostly under the impact of the 2.8 billion euro contraction in the goods deficit as a result of the combined impact of exports growing by around 6% and imports declining by the same percentage against a backdrop of, among other things, lower energy balance deficit by around 1.8 billion euros. Another factor driving the deficit down is the continued vibrant growth in manufacturing exports, thanks to investments in tradable sectors, as well as growth in the services trade surplus. Also, 17 of the 23 manufacturing branches posted growth, especially the ones associated with the car industry and the production of machinery, equipment and electronic products. Our projection still maintains that the current account deficit this year will be around or even below 2.5% of GDP, which is more than twice lower than last year's deficit. The IMF came out with a similar projection during the second review of the arrangement. According to our projection, the anticipated pickup in the investment cycle and the associated import of equipment and intermediate goods, which will nonetheless be greatly offset by the growth in export capacities and the recovery of demand from the euro area, will lead to the current account deficit trending at around 4% of GDP next year and in the medium term, which is a level that ensures external sustainability. The backbone of external sustainability is also composed of FDI inflows, which overshot 3.7 billion euros in the 10 months of the year, outperforming the corresponding period of the record-setting 2022 and exceeding the current account deficit many times over. This has kept appreciation pressures strong and facilitated an increase in the country's FX reserves. Once again, I would like to emphasize that we have secured record-high FX reserves and the relative stability of the dinar against the euro, which we have preserved through all of the previous episodes of elevated international risks. They have been and remain an important pillar propping our macroeconomic stability during this global crisis. I would like to draw your attention to the fact that one text box in this report is dedicated to trends in the FX market and indicates that an improvement in the balance of payment flows contributes to an increase in the number of local companies selling foreign exchange, which is conducive to the more favorable structure and deepening of the domestic foreign exchange market. In the year to date, we have recorded a fiscal surplus of 0.3% of GDP, which is a much more favorable result than the one initially projected. This was facilitated by revenues outperforming the planned figures, notably on account of increased corporate profitability in the past year and reduced transfers to the energy sector. Thus, we created room for fiscal policy to support domestic demand without jeopardizing the declining trajectory of public debt. We estimate that the adopted fiscal measures on the expenditure side, wage growth in one part of the public sector and in payments to pensioners, will not have a major effect on inflation, as you can read in the text box on the fiscal impulse that we have prepared for this report. The medium-term fiscal framework, whose important anchor are the adopted fiscal rules, projects the continuation of responsible fiscal policy conduct with a reduction in the share of the deficit in GDP from 2.8% this year to 1.5% in 2025. Going forward, a sizable portion of budget funds is planned to be earmarked for boosting investments in road infrastructure and the energy sector, thus helping to increase our economy's production potential. Ladies and gentlemen, dear colleagues, I believe that all of the above said clearly shows that the Serbian economy has demonstrated a strong resilience to the many challenges from the international environment that we have faced over the past several years. Understandably, nothing is not resolved on its own. To achieve resilience and maintain macroeconomic stability, we needed to pursue consistent and responsible economic policy, implemented in a synchronized manner and working proactively by identifying potential issues on time and preparing appropriate solutions, including the implementation of the necessary structural reforms, some of which were quite painful. Nevertheless, despite the undoubtedly good results, our job is not yet done, and there will always be new opportunities and challenges looming on the horizon to be used or overcome. And I can say that one sentence is particularly relevant for these times, and I often say it: there are no final victories. Aware of that, the National Bank of Serbia will continue to keep a close eye on and analyze movements in the international environment in order to better estimate their impact on our economy and react in an appropriate and timely manner. Our priority is the return of inflation within the target tolerance band, while safeguarding financial stability and, as much as we possibly can, preserving room for the growth of our economy, employment, and our citizens' living standard. I will now give the floor to Savo Jakovljević to elaborate on the GDP and inflation projection. After that, Milan will say a few words about GDP growth, whereas Mira will try to explain one of the text boxes contained in this report you will receive after her expose. Vice Governor Željko Jović and Vice Governor Nikola Dragašević are here too, and we will be happy to answer any of your questions. Thank you for your attention.
I'd like to provide a few more details regarding our new inflation projection. So the new projection is similar or practically the same as the August projection, and over the entire year already. So this is the fourth edition of the report this year. We have had the same inflation path, and inflation outturn is as we have planned. What has changed are the levels or averages that we expected for this and next year. But in general, the projection and the movement of inflation are consistent with our expectations for this year. As for the averages for this and next year, average inflation this year is expected at 12.5% and 4.6% next year. This is a slight change compared to the August inflation report, when the average for this year was 12.7% and for the next 4.4%. For this year, you can see that the average has been reduced between the two inflation reports. The major part of it concerns a slower rise in food prices. That is a slowdown in the growth in food prices. That is the monthly inflation rates concerning food were slower than we expected in August, and in July and August we saw a decline in food prices, and in September and October we saw the stagnation of these prices, and we expect such developments to continue until the rest of the year. In year-on-year terms, food prices, if we compare this rate in March, when inflation was at its peak, the growth of food prices was 25.4%, and in October this growth measured 10.5%, and already from November we expect expect year-on-year food price growth to be at a one-digit level, and we continue these prices decrease in the coming months. The slowdown in the food price growth and the stagnation is due to the better agricultural season, which was even better than we expected in August, and the costs of agricultural producers have also fallen, meaning that producer prices in the food industry from the beginning of the year to October are by 1.6% lower cumulatively. This is all in line with what we announced in the August inflation report. Mainly the entire increase in food prices for this year will be realized in the first half of the year, whereas in the second half of the year we will see a stagnation or a fall in these prices. As for the short-term projection for the coming months, the downward trajectory of inflation will continue. In November, it will also be declining, although at a slower pace because of the increase in administered prices. This will continue in December, and by the end of the year, it will be 8%. And in 2024, we expect inflation to enter the target tolerance band by the mid of the next year. And this pace of reduction is also expected in the first quarter of next year, where the average is 6.2%, meaning that inflation will be below 7%, most probably already in the initial months of the next year. This is supported by food prices and a reduction in these prices. When we talk about monthly rates, that is the stagnation or a decline year on year, it means that rates are positive. If we compare the same month of this year with the same month of the last year, we have seen an increase, but this increase is being increasingly lower. As for the oil prices, the average for the next year is somewhat higher by 0.2 percentage points. But this is only a moment at which we prepared the projection. At the time, the oil prices were somewhat higher because of the outbreak of the Middle East conflict, and they just soared even up to $95 per barrel. This moderated very quickly and returned to the pre-conflict levels, and now the price is somewhat above $80 per barrel. As for futures, we can also see that this shock was relatively limited. Of course, there is a risk, and we will monitor the risk in the coming period, but for the time being, we expect no major spillovers of this factor. And as for our expectations for the next year, because this is the monetary policy horizon, in the last quarter of 2024, we expect average inflation to be somewhat above 3%, meaning that by the end of the next year, we can even reach the midpoint, which equals 3%. Of course, each projection is associated with risks. Now we have the risks from the international environment, and domestic factors even impact a somewhat lower than expected outturn of inflation compared to August. Thank you. I will say a few words about our new projection of GDP growth for this and next year. As you can hear, the National Bank of Serbia revised upward its GDP growth projection for 2023 from the range from 2 to 3%. We communicated it would be closer to the lower bound of this range, that is 2%. So we revised it to 2.5%. There are three key reasons for the upward revision: a better agricultural season, industrial production despite the slowdown in the euro area and owing to the inflow of investment over the entire year compared to our earlier expectations. And finally, we also have seen somewhat faster growth in construction, owing primarily to the acceleration of infrastructural projects being implemented in the country. When it comes to quarters, in the first half of the year, we saw somewhat slower growth, 0.9% Q1, 1.7% Q2, and in Q3 we saw acceleration to 3.5%, and this is somewhat larger than we expected before. That's why we revised the projection. As for as for the fourth quarter, it will be between 3.5 and 4%, and this is necessary for us so that we can achieve the annual growth of 2.5%. A good thing concerning the acceleration of growth is the fact that we will enter next year from a higher level. We have a good tendencies transferred from this year, and also, owing to this high level with which we will enter the next year, it will be easier for us to achieve growth between 3 and 4% next year than it was easy for us to achieve the growth of 2 to 3% this year. Around a half of the GDP growth next year will be determined by consumption growth. 3.5% is the projected GDP growth. Personal consumption will rise by around 3% and give a contribution of around 2 percentage points. This is with the included increase in wages and pensions and the included increase in the minimum labor cost, which is defined for the next year. As for the nominal rise in consumption and nominal rise in GDP, we expect next year that consumption will rise around 8% and GDP 8.5%, which is very important from the aspect of sustainability of GDP growth, because we will still have a slight decrease in the share of consumption in GDP growth, and this will leave more room for investment. If wages go up by 10% and pensions 14-16 and the minimum wage 17%, why do we have the 8% figure? Because we will have a reduction in other sources of consumption, primarily loans intended for consumption and remittances as well. We cannot expect them to be at the level of this year or at the level of 2022. And as for the fiscal sustainability of these increases, including these increases, next year we will have a lower fiscal deficit than we had this year. This is very important for us because we will not have inflationary pressures on this account. The public debt share, along with these indicators, will decline from around 53% by the end of this year to around 51% next year. So this is also very important to us because we are facing huge international uncertainties, and all countries, including Serbia, are borrowing at much higher interest rates than it was the case before. And as for the exports, they're still rising. They're slower over the past several months than we would like them to be because of the slowdown in external demand. But as for the first 9 months, goods exports rose by 6% and services exports rose by over 20%. At the level of the year, we will reach the exports of goods and services of 41 billion euros, whereas in 2019, before the pandemic, this figure equaled 23 billion euros. One of the important reasons is not that Serbia is, by a miracle, resilient to a reduction in external demand, but because we are increasing our export supply. Each year we have investments in tradable sectors. 50–60% of FDI goes to export-oriented sectors, and so we are increasing our export supply, and our services sectors are going up. Serbia has already 4 services sector whose exports is individually higher than the export of agricultural products. IT sector, the sector of business services, transport sector, and tourism as well. So all these 4 services sector individually have higher exports than the exports of agriculture.
Ja bih se u nastavku kratko osvrnula na navode koje smo mogli čuti u medijima prethodnih meseci.
I would just like to touch on some criticism on account of inflation in Serbia, and that is that inflation peak in Serbia has been reached somewhat later than in other European countries, and that with the exception of Hungary, inflation in Serbia is at the highest level. In this respect, I want to highlight several key facts. First, since March this year, when we recorded inflation peak, inflation has been lower by 7.7 percentage points, and in October this year it measured 8.3%. 5% year-on-year. Inflation slowdown was aided by the lower growth in food prices, notably processed food, and since July also unprocessed food, but also it was aided by lower core inflation, which touched single-digit levels and in October measured 7.3%. If we compare our situation with inflation targeting regional peers, the same situation was faced by the Czech Republic in October, whereas in Hungary inflation amounted to 9.9% in October, while Romania had a slightly lower inflation of 8.1%. This means that in all these countries until the end of the year, inflation will range from around 7 to 8%. So they will all have similar inflation levels. What is important to note is that in contrast to Serbia, where we expect inflation to return within the target band in mid-2024, most other regional targeting peers expect inflation to return within the target band not before 2025, with the exception of the Czech Republic, where return is expected in early 2024. The IMF has a similar view on this. The second very important thing is that the inflation peak in Serbia has been reached at a lower level than in most of the observed countries, which means that in those countries they had a larger base effect this year, that the slowdown in inflation in those countries was aided by the dropout of the last year's price hikes from the year-on-year calculation. There are two key factors behind the fact that our inflation peak was reached somewhat later. First, it was the decision of the government to distribute the gas and electricity price increases over a period of 2 years in order to protect the economy and the living standard of citizens, whereas in other countries we have this large base effect because the price hikes are dropping out from their year-on-year calculation. The second factor is the high growth in vegetable prices as a result of reduced supply in the domestic market caused by the drought in the last 2 years. And an additional effect also came last spring, when we had inclemental weather. Around mid-year, the year-on-year growth rate of these prices was grew at the rate of over 40%. And later on, as the supply increased and as agricultural season turned out to be better than expected, this price growth softened to below 13% in October this year. Having all this in mind, we think that it is more adequate not to compare countries at a certain point in time if you look at inflation. If we look at the cumulative inflation growth from 2021, that is since the moment we have faced numerous shocks at global level, we can see that inflation in Serbia, the cumulative inflation growth in Serbia was at the level of the average for the region of Central and Southeast Europe. But if we look at core inflation growth was almost the lowest in the region, and this is definitely due to the relative stability of the exchange rate, but also due to the effects of monetary policy tightening. You can find more information about this in one of the text boxes in our inflation report, which concerns inflation prospects at home and abroad.
Bojan Stevanović, and one. I have two questions, perhaps three questions as well. If you observe the trends, wages have gone up, prices have gone up faster. As for statistical data, we have somewhat more money, but we can buy less goods, primarily food. When will this trend reverse? So when we go to a shop, when we will be able to buy more with more money. As for Forbes, my colleagues published an article about payment operations with Russia, and they're waiting for a response of the NBS. The question is, are there banks in Serbia that have payment operations with Russia in 2022 and 23, and which are these banks, if there are any? And I would like your colleague, I would like to ask her, what is wrong about the media writings? You mentioned 8.5 here and in the Czech Republic and 9.9 in Hungary. So what is wrong there? So yeah, only in Hungary inflation is higher than here. So what is wrong about that? We didn't say that the data are not correct. At some moment, inflation in Serbia was at a higher level than in other countries. So nobody is denying this. But if we state this data, we have to take into account the factors that impacted this trend, and it is not adequate to make such comparison, because right now in October, for example, in the Czech Republic, inflation in that country is at the same level as in Serbia. So if the central bank targets are usually defined as year-on-year inflation, so current developments impact inflation, but also the developments from the same period of the last year. So it is adequate to observe all the elements, not only the current moment when it comes to different countries. We're not saying that this data is incorrect, but we just point out the facts and the factors that should be taken into account. So we had this and last year a revision of electricity prices. Others made this revision usually mainly last year, and now they're facing a large base effect. That is the dropout of last year's increases from the calculation, and that's why inflation was falling faster in these countries than in our country. But now the situation is almost equal, and until the end of this year, we expect inflation to move between 7% and 8% year on year. I would like to add, Samira does not go out of the bounds of a professional attitude, and she doesn't want to banalize the way in which we talk about inflation. So please take into account all the facts, but try to interpret these facts, having in mind the entire picture. So we are in the same category of weight, we're a heavy category. But what is your age, what is my age, what is my style of life, what is my history, and what is your history? So these are the specificities that you do not take into account when you talk about inflation, but you observe only a particular moment, not the manner in which the government wanted not to spill over the effect, the burden of inflation. We are not to be blamed for inflation because we didn't print money. We are not such a large country, which, when it comes to the movements in commodity and financial markets, that could trigger disturbances that engulfed the whole world. So we never had negative interest rates. We never enlarged, inflated the bank balances as others did, and some people wanted to call our monetary policy the new monetary policy, meaning that the money costs but it doesn't earn. But we are suffering the consequences just like all the others. The ways in which we defended ourselves from these shocks was our specificity. This is our general response that is called Serbia has its own path, its own heritage, its own answers, and its own responsibility. And it is accountable before the citizens in terms of saying what we are planning to do, what we are facing. So why am I emphasizing all this when it comes to inflation? Serbia is a rare country where when the IMF, the World Bank, cannot say that there is not a single hidden data.
troškovi
So we inherited a situation when many debts and many costs were below the line, hidden under the carpet, and investors did not have a clear picture of what they will face when buying our securities and when investing in the Serbian economy. So now when we have the IMF, and we have had it since the negotiations in 2014 and the arrangement of 2015, and even when so far we haven't needed the money, we don't need their money now either. Our reserves are high, but we want to be certain. So the IMF literally is another pair of eyes that should confirm to the world the transparency of the figures and the data and the calculations that we make. When
deflatoru za inflaciju koji primenjuje Ministarstvo finansija
When it comes to our projections and the inflation deflator applied by the Ministry of Finance, if there were any problems in this regard, you think that the IMF would disregard this? No. So I respect the profession that you belong to. I respect your analytical work. But please bear in mind that a serious invested effort should imply the observation of the whole picture. And I will return to the main thing. You say, what can we buy for money now and then? Who? You, me, Anica, or this beautiful girl dressed in white? Nicola doesn't know who she is. So the question is, who and how much can buy? So what is this stratum of citizens? What is this number of citizens? Who buys what? You and me may be an average. Somebody is below the average, or somebody is far above the average. That's why we have inflation as the general average of all prices. And as for basket items, they're determined by each country. Items can be added sometimes, but it consists of those items that are used most often. But my answer cannot be one-dimensional. So we have to think about the specific category of people that we talk about. I'm under the influence of the news from the last night. I didn't have time to attend the government session, but I heard the news that the total number of doctors who volunteered or were engaged on part-time contracts were employed full-time, and they were engaged during the COVID pandemic. I was really proud when I heard that news. Do you understand? This speaks volumes about the strength of our country. This is not only one-time assistance. This means employing full-time doctors who will care about your health and my health, because neither you and me take care about our weight. So we are always prepared to explain inflation in Serbia. We also say to the IMF, it's one medicine does not cure all the illnesses, and everybody has a specific path, specific heritage and possibilities to fight inflation, and Serbia has exceptional opportunities. 24.4 billion of gross FX reserves. Net are our reserves. So these are not required reserves of the banks or obligations towards banks. So these are net reserves are over 20 billion. Food prices are already now rising at a slower pace, and Milan will now explain how we see that at this moment. But when you ask when we will be able to buy the same quality of goods for the same amount, and I'm asking you what? You and me, dinars, euros, where are we buying? Do we make sure where coffee is cheaper or not? So you're a journalist, and it's impossible to answer questions with a simple yes or no. So there are many nuances. So food prices have already started to rise at a slower pace.
Mi smo dobili, ja sam juče pročitala tekst koji jeste jedno, da kažem, ozbiljno
When it comes to your question regarding Russian banks, yesterday I read an article presenting a serious research, but like any research, it is a targeted research, and I think that Serbia, and you're witnesses to this, really takes care not to jeopardize itself or its banking sector by breaching the sanctions that we monitor on a daily basis and which and before the correspondent banks are officially announced. Of course, there are some things we can discuss openly, but there are also some sensitive issues that I would not like to go into detail and I would not like to tackle publicly because they can be misused. So we will see once our colleagues from the Bank Supervision Department submit a report to us, but we will need banks to submit their reports and specific data to us, and then we will deliver a specially designed response to you regarding this matter. I will use this opportunity to say something. I think that you keep abreast of how access to public information is abused. You know, the right of the public to know and the right of the government to secure its interests, they're always bordering. Your freedom, if your freedom encroaches upon mine, then the question arises whose freedom is more important. I'm talking now about the banking sector, about the functioning of an individual bank. You are asking answers that we do not usually give. We do not usually give answers for specific banks because granular data and this type of statistical protection, so to say, that official producers, such as the Statistical Office and the National Bank of Serbia, have to maintain, means that sometimes we cannot expose individual entities by speaking about their individual contracts and relations, just as we do not go public with individual firms coming from China or individual companies from Europe when we're talking about foreign direct investment or anything of the kind. So we are an institution that adheres to certain rules, and that is why we deserve the confidence of foreign investors. Milan will now say something about the prices. I think that we have to look at the coverage of the minimum consumer basket with the minimum wage, given that the minimum consumer basket is composed mostly of food. So how did this coverage move? Until when did it rise? How much it equals now? And at what level will it be at the end of the year? 10 or 15 years ago, from 2009 to 2013, the coverage of the minimum consumer basket with the minimum consumer wage was around 60%. When did it start growing? It started growing in 2017 and it rose until 2021 when we reached the coverage of around 81%. Since then, it has mildly declined. This year, it equals 77.7%. I'm talking about the first 8 months of the year, the coverage of the minimum consumer basket with the minimum wage, currently below 78%. When talking about the minimum wage, starting from January 2025, which will be 47,000, and we think that minimum consumer basket will equal around 55,000 dinars next year, it would be realistical to expect that we will have an increase in the coverage to around 85 to 86%. Your complaints about my weight, I know they're not malicious and I will not take them amiss, but I think that it is inappropriate to speak about the public's right to know. I think that it comes before all other rights. Listen, we are now opening a topic that I will gladly answer. this does not concern the inflation report, and maybe it does. So when someone is citing the right of access to public information, the question arises, what is the motive and to what extent this jeopardizes, this threatens the individual who is the subject of the topic. Individual freedom based on which and the whole system of democracy is based does not concern only a journalist and a journalist profession, but also mine, or Željko's, or anyone else's. The question of what is more important, public interest or the right of an individual about consumer habits or baskets, what should remain secret, this is an issue that we have to re-examine all the time. For instance, let's take Visa or MasterCard, two most renowned card systems. Were you able to get data from them about any individual, about their spending habits, about their travel patterns? No, you did not. I'm telling you quite specifically, we have statistical confidentiality and the protection of those whom we process statistically is the kind of individual freedom or business behavior. For instance, when we lowered interest rates, when we capped the interest rate on housing loans, agreed with variable interest rate, there were those who said that we have interfered in contractual relations. Now let us discuss whether what is more important, a contractual relation between a bank and a client, or is financial stability of the whole country and the level of non-performing loans more important. And now I'm wondering why some journalists and analysts defended banks more than the banks themselves, who gladly accepted this measure of interest rate cap because they realized that an increase in non-performing loans would bring them into an unfavorable situation and that it would block their funds in those non-performing loans, and in this way, where their profitability and earnings because of the high interest rates of the ECB and the rise in the key policy rate, and all because of the impact on inflation, their profit has significantly increased, and the level that they will have to change in their planned earnings in 2023. Some of them are already doing it. They're adjusting their plans. This means that only 10% of their profit from interest will be sacrificed, and this is not an amount that they cannot sacrifice. And at the same time, it will maintain their relations with clients, it will maintain the quality of their assets and the financial stability of all of us. So the question is, what is more important? What is the general interest? What is the interest of the system? What is the interest of those who are fighting that interest? I'm now being quite open, and you can ascribe anything to me, maybe political awareness, but political blindness, never.
As for the year-on-year decline of inflation to 8.5%, so what were the main contributors? Sina Shamali said that it is the result of the action better price. You talked about the slowdown in food price growth. So what is the factor behind it? And what is the effect of external demand? What happens when the high base drops out from the calculation? Did that happen in October year-on-year? Because last October we had a high base which dropped out of the calculation. So because inflation was so what contributed to this decline the most? And the second question concerns the IMF arrangement. You say that it may become a precursor precautionary arrangement. So as for such decision of the IMF, should the government be in full convocation? Because last time when the IMF was here, the government had to be in full convocation, and here we have an overlap with the election cycle. So this is this a formal condition or not? Before Milan answers to your first question, yeah, you mentioned all the factors that impacted the reduction in the inflation rate. I will answer your question about the precautionary arrangement. This means that Serbia does not plan to withdraw the second tranche of the funds approved to it. So these funds are available to us, but we don't want to pay interest on them. In December, the Executive Board will have on their agenda the analysis of the success of the program. As for the moment when the funds will be withdrawn, this is something we're not talking about right now. The adoption of the second review does not mean that the funds are automatically transferred to our account. We will be agreeing with them on this issue, but it is our decision. Our decision has already been made, so it will be a precautionary arrangement further on the condition that the geopolitical circumstances do not deteriorate, which can, as you know, change over time. As for the technical mandate or any other mandate is a technical question. So these are the key decisions, and but we will talk about it when we come to that point. As for the October inflation and the effects of different factors, I will start from the high base that you mentioned, because the situation there is the clearest. In October last year, monthly inflation was 1.8 or 1.9, and now the inflation is 1.3. So obviously the base effect is around 1.5 percentage points. As for the effects of the Action Better price, it's not possible to give a precise answer. Because the CPI covers 660 products and services. Within each type of services and products, we monitor several producers, so the prices of several producers, but not all producers. So that's why it's not possible to give the most precise estimate. We can say that the types of products, including products whose prices are kept by the Action Better price, so these groups or these types of products recorded in September a decline of several percentages, and in October as well. So in general, the contribution of these types of products could be around minus 0.3 or 4, but I said this with reservations because we do not monitor the prices of all producers. And some specific products are also limited, and we are not sure whether they enter the CPI or not.
Jedno pitanje iz agencije Bloomberg. U vezi sa aranžmanom sa MMF-om, vi ste
Bloomberg Agency,
rekli ste nam
as for the IMF arrangement, you said that it will become a precautionary arrangement. In the meantime, I read a statement, I was surprised. I have to check something. First, possible accelerated payback of some funds, and perhaps after changing the nature of the arrangement, the level of the monitoring by the IMF will be reduced, perhaps. Is that correct? No, that's not correct. Neither of the statements is correct. So we had two PCI arrangements. So this is the policy coordination instrument, and we had absolutely the same level of insight on the part of the IMF into all the business books of the of the state of Serbia. Even when the arrangement was called the policy coordination instrument, when we started negotiations about the arrangement with the IMF in 2014, for the sake of reminder, when the president of the government was Alexander Vučić, he understood how important it was that the IMF should have insight into all our data, because everybody trusts the IMF, all investors, and those who observe Serbia as a business destination, and not only them. Since then to date, the level of the monitoring by the IMF of what Serbia is doing has not changed a jot. So we have Article 4 reviews, and each country has that. And we also have detailed reviews as well. The dynamics has only changed. So now we have six-month reviews now, and before we also had 3-month reviews. But the communication with the IMF is happening on a daily basis. I don't know whether you're familiar, but we also have a regular safeguard mission by the IMF, when the representatives of the safeguard mission have the right. So this is a team consisting of 5 persons, lawyers, up to the chief, Ali Shamoun, and they got the right to enter the treasury of the NBS, and they made sure that we do have the gold in our vaults. So this inspection, the level of the inspection is so high, so they're really interested in what is happening in Serbia, and they also had an interview with myself about the way I choose my associates and about the way I propose the vice governors for election. Some of the vice governors are here, some of them are waiting for me to join them at the ECB conference, which is very important for us. One of our vice governors is there, and they're all sitting there while they were asking me what motivates me when I choose vice governors. Should it be a person outside of the bank, and so on. I take particular pride in the fact that me and the government, from the president to the government, is there insight into everything we do. And I believe you are aware of what's going on right now in the world. So basically, countries want or do not want to be fully transparent towards their lenders. So we are transparent even when we do not ask. We do not want to borrow money, in fact. So we had this transparency since 2014 until the latest arrangement. We didn't need money, but we have been fully transparent. So the problem in the world is the fact that many creditors give funds to countries, particularly in those regions that are interesting in the world right now, starting from Africa and so on, without having a clear insight into all the developments. So just like the IMF has these transparent insights into the situation of the countries where it conducts regular reviews. So we will not have to prepay the funds, and we will not withdraw further funds, given the current circumstances, and the pace of the repayment is as has been agreed, on the condition that we do not experience any major shocks when we would need new buffers, and we think about interest as well. You know that interest at the IMF is defined on a weekly level, and it depends on the interest rates in the world, and that's why we burden you with all the decisions of the central banks across the world. In the US, we talk about the structure, the currency structure of our and so on. But we are transparent to the extent that we have no secrets before the IMF, And I'm sorry that Mr. Donald, before his departure, contracted the coronavirus. He got tested, and we didn't hold the press conference at which you could have heard all this from him. And they're really constructive, and as I said, our communication is highly transparent, and I always say that we are partners. So we're not somebody who executes orders, but to be a partner of someone, you have to put all the figures on the table openly.
I would like to switch the focus on GDP growth. We heard that this year GDP growth will be powered by net exports. Next year, if I understood correctly, it will be powered by domestic demand. So I'm wondering what is happening with net exports, what will happen with net exports and other drivers and other contributors to GDP growth in 2024. Thank you for your question. Like you said, this year the key contribution to GDP growth is coming from net exports. The contribution of net exports exceeded our earlier expectations, and it has pushed GDP growth up and also contributed to having the lowest current account deficit on record. It is not realistic to expect that in an environment of slowing euro area economy we will see a repeated result of this kind. We had lower quantities of exports, of imports this year, and both in price terms and in quantity terms. So we're speaking primarily here about quantity terms. Next, it also has to do with imports, with real increase in consumption and with the real increase in investments. Imports of equipment and intermediate consumer goods will increase. You cannot have a continuation of investment cycle and an increase in investment to 23 to 24% of GDP without importing equipment. So equipment imports amounted to 1.5 billion or 2 billion euros, and now it equals around 5 to 6 billion euros a year. If the investment cycle continues, and it will, it's reasonable to expect that in 2024, 2025, and 2026 or 7, we will not have such a huge contribution of net exports, because we will import a lot of intermediate goods and equipment. And if we add to all this an increase in consumption, we will have, as a result, a negative contribution of net exports. It all depends on the dynamics of the investment cycle. If investments reach 25 to 26% of GDP, which would be excellent, we will have a negative contribution of net exports, and this is something we have factored into our projections. When it comes to the current account deficit, we projected this year at 2.5%, whereas next year we expect it to return to 4%, which is a sustainable level in the longer run, because we need investment. So we have to take into account several different factors. Whether your projections include the potential entry into force of free trade agreement with China. It is difficult to incorporate this into projection directly, because there are thousands and tens of thousands of different products. But what we definitely took into account is that Serbia has a lot of free trade agreements, and they're increasing, and that is why we are having this amount of investment, and that is why we project such a high level of investment, and thanks to this we project GDP growth, but we cannot include specifically one free trade agreement. We adhere to the basic accounting rule, and that is the rule of caution. So all expenditures can be counted on and calculated regardless of whether they are due for payment. And we count on revenues only once they are on our accounts. We stick to this in our projections as well. So if there are no further questions, thank you for attention and see you next time.